Welcome, learners, to another deep dive. Ever stop and think about what actually powers those massive jets, lifting hundreds of tons, thousands of feet up?
It's pretty incredible when you picture it.
Right, or the tech behind the defense aircraft protecting us. Well, chances are, right now, almost 1 million people are flying, and GE Aerospace technology is making that possible.
It's not just the engines either, though they're obviously key. It's this whole invisible, high-tech infrastructure.
Exactly. That underpins global travel, global defense. So today, we're doing a deep dive into GE Aerospace. It's recently emerged, kind of on its own, as a real powerhouse in aviation.
A standalone giant, yeah.
Our mission, to really unpack its unique position, understand its business model, which honestly might surprise you.
Surprisingly, a lot of people.
We'll look at its latest performance, and maybe the most exciting part, get a peek into their big plans for the future of flight.
Think of it as your shortcut, your essential guide to understanding a critical, super high-tech industry that, well, shapes our world daily.
So what you'll learn today, it goes way beyond just the headlines or, the quarterly reports.
Absolutely. We're going to show you how GE Aerospace really makes its money. And spoiler, it's not mainly from selling new engines.
We'll get into the big challenges they're facing. Global trade stuff, supply chains.
Yeah.
Everyone's dealing with that, right?
Oh, yeah. Big headwinds. But we'll look at how they're strategically fighting back.
And maybe the coolest part, there's incredible innovations. What's coming next for aircraft?
Get ready for some real aha moments. The scale, the complexity, the long game they're playing. It's a fascinating stuff.
Okay, so before we jump into where they are now, maybe let's just quickly touch on where they came from. I mean, most of us remember GE as this huge conglomerate, right? General Electric.
That's right. A massive entity covering everything from light bulbs to power turbines.
So spinning off GE Aerospace,
Mm-hmm.
what was the thinking there? How did becoming standalone help it, take flight?
That's a great place to start because, yeah, its current form is pretty new, but the name, the legacy, is instantly recognizable.
Still got that iconic GE ticker symbol.
Exactly. It emerged from a series of really strategic spin-offs. It wasn't just shuffling deck chairs. It was about creating focused, more agile businesses. GE Aerospace kept the GE name, kept the ticker, signaling that legacy, but also a fresh start purely focused on aviation.
And that focus seems to have helped no distractions from other industries.
Precisely. It lets them accelerate their own strategy without the complexities of being part of a giant multi-industry parent, pure play aviation.
And the market reaction. It seems like investors really like this new, focused approach. The stock performance tells a story, doesn't it?
Oh, absolutely. The market response has been, well, overwhelmingly positive. Look at the stock. It's a real testament to the underlying strength.
It went from what, around $50 in 2021?
Yeah, and soared up to $200 by January 2025. Impressive run. There was some volatility, sure, dipped to maybe $160 with those trade war jitters.
Which we'll get into later.
Right. But it bounced back quickly to that $200 level. And as of May 2025, you're looking at a market cap around, what, $247 billion. Share price, $231.08.
Yes, huge numbers. That resilience, it's not just luck, is it?
No way. It points to a really robust business model and, frankly, some serious competitive advantages. They've quickly cemented themselves as, an indispensable supplier for the world's best-selling planes.
Okay, and this is where it gets, like you said, maybe counterintuitive for people listening. We think engine maker, we think sell engines, make money.
That's the natural assumption.
Yeah. But GE Aerospace, they play a different game, don't they?
They really do. And this is maybe the most crucial thing to understand about their core strategy. Yes, they design and build these incredibly complex, powerful engines, commercial, military, the works.
Amazing machines.
Truly. But financially, fundamentally, they operate as a services company. Think less, buy a car, more subscribe to a total vehicle care plan.
So like the razor and blade model, but on a massive scale.
Exactly. A staggering 70%, 70 of their total revenue comes from services. Maintenance, spare parts, overhauls, upgrades. Everything after the initial sale.
70%. That's
Wow, and drill down further. Commercial aviation alone makes up 70% of the entire company's revenue. So it's not just a tilt towards services. It's the absolute bedrock of their financial structure.
So that initial engine sale, it's almost like the entry ticket to decades of service revenue.
You've got it. That 70% figure is the real eye-opener. It shifts the whole perception from just selling hardware to being a long-term partner.
And that deep integration must give them incredible advantages.
Huge advantages. Predictable high-margin cash flow, for one,
Yeah.
but also these incredibly sticky long-term customer relationships. It gives them unique insights, real leverage. They become indispensable for the entire life of that very expensive asset.
Now, this market they operate in, commercial aircraft engines, it's not exactly crowded, is it? Is it a free-for-all or more like a private club?
Think very exclusive private club, maybe with only 3 members allowed in. It's a classic oligopoly. You've got GE Aerospace, mainly through their incredibly successful joint venture with Safran of France. That's CFM International.
Right, CFM. You see that name everywhere.
You do. Then there's Rolls-Royce, the British giant, and Pratt & Whitney, which is now part of RTX. That's basically it for the big commercial engines globally.
And this structure, it kind of mirrors the plane makers themselves, right? Airbus and Boeing.
It's a direct parallel. Airbus and Boeing have a virtual duopoly on large commercial aircraft manufacturing, and crucially, neither Airbus nor Boeing builds their own engines.
They rely entirely on these specialists.
Entirely, which makes GE, Rolls, and Pratt incredibly powerful and critical partners in the whole ecosystem.
And within that exclusive club, GE Aerospace, especially through CFM, has really carved out a dominant niche, hasn't it?
Absolutely dominant in one key area. The narrow-body segment, these are your workhorse jets, the Airbus A320 family, the Boeing 737 MAX, the backbone of almost every airline fleet worldwide.
And CFM powers most of those.
The vast majority. It's a huge market share. Rolls-Royce, on the other hand, is the major player in the wide-body segment, the bigger twin-aisle jets for long-haul routes.
Okay.
And Pratt & Whitney also has a significant role, primarily in narrow bodies, competing with CFM, and also in smaller regional jets, so there's segmentation.
And looking ahead, are there big shifts happening in what kinds of planes airlines want?
Definitely. We're seeing a really strong industry trend towards narrow-body aircraft and also wide-body twin-engine aircraft. Think 787s, A350s, the upcoming 777X.
So fewer four-engine giants.
Pretty much. It signals, as some say, the end of the ultra-large aircraft era planes like the A380 or the classic 747 passenger versions. The demand now is for efficiency, which twin-engine designs offer.
Which must mean demand for bigger, better twin engines.
Exactly. Larger, incredibly fuel-efficient engines, pushing the boundaries of technology and physics, really.
So if 70% of revenue and even more of the profit comes from services, let's talk about the life cycle of that engine. It's not just about day one, right? It's the whole journey.
Precisely. This is where the long-term strategy and value really crystallize. GE Aerospace makes most of its profit not from that initial sale, but from the decades of MRO, maintenance, repair, and overhaul.
MRO. Got it.
Think about it. These engines are incredibly complex machines, thousands of parts, extreme temperatures, immense pressures, flying for tens of thousands of hours. They need constant, highly specialized care.
Like a high-performance athlete needing constant training and medical attention.
That's a good analogy. And that means the size of their installed fleet, every GE or CFM engine currently flying out there, is absolutely critical.
More engines flying equals more service work down the line.
Directly. A larger fleet translates directly into more predictable, recurrent, high-margin profits because every single one of those engines needs servicing over its, say, 20, 30-year lifespan.
And that must forge incredibly tight bonds with the airlines. You're not just selling them something, you're partnering for decades.
Unbreakable bonds, almost. This service model creates exceptionally deep, long-term relationships. They shift from being just a supplier to being a truly integrated partner.
Which gives them
Unique, real-time insights. How are the engines really performing in the heat of the Middle East versus the coals of northern Canada? They see it all. They can anticipate maintenance needs, understand operational quirks.
and feed that back into designing the next generation of engines.
Exactly. It's a powerful competitive advantage. Now, it's worth mentioning, and this is true across the industry, new engines often have teething problems early on.
Right, you hear about that sometimes.
Yeah, Pratt & Whitney had some issues with their PW2000G requiring early inspections. CFM's own LEP needed some tweaks for hot, dusty conditions. Rolls-Royce had issues with inspection intervals on the Trent XWB-97.
So bumps in the road are expected with cutting-edge tech.
It's part of the process when you're pushing the envelope this hard. But despite those early challenges, the long-term outlook for these advanced engines and, crucially, the services supporting them remains incredibly strong.
Okay, let's shift gears and talk hard numbers. Strategy is one thing, but execution is another. GE Aerospace has been performing really well lately. What did their Q1 report signal to investors?
Yeah, the market definitely liked what it saw in Q1 2025. Shares ticked up maybe 1-3% in pre-market trading right after the report. There was this palpable sense of optimism.
Driven by what specifically?
Better than expected earnings, for sure. And just generally strong trends in commercial aerospace, people flying again, airlines needing planes and maintenance. Wall Street analysts still incredibly bullish.
I saw that strong buy consensus.
Right, 16 out of 16 analysts saying buy. Average price target around $230. That confidence, it's rooted in GE's dominant position. That huge services backlog we talked about, which is like guaranteed future revenue and their free cash flow, which is really improving.
So the market believes they can deliver on that service model.
Exactly. Analysts are basically saying executing this services ramp up is absolutely key to hitting their targets. So a confident outlook, even with those external challenges lingering.
Okay, strong start to the year. Then came Q2 results in July. Did they keep that momentum going? Walk us through the key numbers, and maybe more importantly, what do they actually mean?
They definitely kept it going. In fact, Q2 showed accelerating momentum. The results on July 17th were impressive right across the board. Orders new business coming in hit $14.2 billion.
That's up significantly year over year.
Up 27%. That's a big jump, a strong indicator of future work. Adjusted revenue was $10.2 billion, up 23%. So strong top-line growth.
And profitability.
Adjusted operating profit also up 23%, hitting $2.3 billion. And importantly, the margin was strong at 23.0%.
Why is that 23% margin such a big deal in this industry?
Well, think about the huge R&D costs, the long development cycles, the intense competition. Hitting a margin like that shows real pricing power and serious operational efficiency.
Yeah.
It tells you they're not just selling stuff, they're commanding real value for their tech and services. It's one of those aha moments. They're executing really well.
Got it. And earnings per share? EPS.
Big jump there, too. Adjusted EPS hit $1.66, up 38% year over year. That's strong bottom line growth for shareholders.
But the number that really jumped out at me was the free cash flow.
Oh, yeah, that was the standout. Free cash flow, the actual cash the business generates after all expenses and investments, the stuff they can use for buybacks, dividends, reinvestment.
The crucial metric, really.
Absolutely. It nearly doubled to $2.1 billion, up 92% year over year. That's massive. So look at the first half of 2025 overall. High teens revenue growth, $1 billion more in operating profit, nearly $800 million more in free cash flow. It just screams strong execution.
Wow. Okay, so breaking that down, what's the main engine driving this growth? Is it mostly that commercial engines and services segment, the CES unit?
CES is absolutely the powerhouse here, no question. Q2 was excellent for them. Services orders up 28%, equipment orders up 26%. So strong demand for both new engines and the aftermarket support.
And how did that translate into actual revenue and profit for CES?
Services revenue climbed 29%. What drove that? Mostly spare parts revenue up over 25% and internal shop visit revenue up 22%. That's the razor and blade model firing on all cylinders.
Makes sense. And new engine sales, equipment revenue.
Also very strong, up 35%. With the actual number of engines delivered, the unit volume up 37%.
So more engines going out the door, feeding that future service stream.
Exactly. And all this strong top-line activity flowed through to the bottom line for CES. Operating profit up 33%, and margins expanded by 50 basis points to a really healthy 27.9%.
50 basis points. That's 0.5% improvement in margin.
Correct. 1 basis point is 0.01%. So 50 basis points is a 0.5% improvement, which sounds small, but at this scale, it adds up to significant profit.
And it sounds like they're managing to actually deliver more engines, too, despite supply chain talk. That indicates a healthy pipeline.
That's right. The demand is translating into deliveries. Total engine deliveries in Q2, commercial and defense combined, were up 45% year over year. That's a big ramp up.
Focusing on commercial.
Commercial deliveries specifically were up 37%. And the LAP engine, their newer narrowbody engine, deliveries were up 38%. For the whole first half, commercial units grew 12%, with LAP up 10%. So yes, a strong ramp in production meeting that demand.
Okay, so with this strong current performance, how does GE Aerospace look at the future? What are the fleet forecasts and the MRO market dynamics they're banking on? What are the key things driving profit moving forward?
Right, looking ahead, the key profit drivers are basically two interconnected things. One, global fleet growth. That means new planes being delivered minus old planes being retired. Two, new engine deliveries, especially these newer, larger, more complex engines that, well, generally need more extensive and costly maintenance later on.
And what are the forecasts for fleet growth?
Most industry analysts, firms like Oliver Wyman, Fleet MRO, McKinsey, they're projecting annual global fleet growth of around 3–4% over the next decade.
Which translates to how many actual new planes per year?
Roughly 1,300 net new aircraft entering service annually, which means about 2,600 new engines needed each year.
And GE, with its narrow-body dominance via CFM.
Is incredibly well positioned. Given they powered the majority of those A320neos and 737 MXs, they're set to capture at least half of that huge engine market. It's a structural advantage.
Okay, what about the MRO market itself? That maintenance, repair, overhaul space, is that growing just as fast? Or is it more nuanced?
It's a bit more nuanced. You might see some forecasts, like one from McKinsey, suggesting maybe only 0.6% annual growth for the overall MRO market. But, and this is critical, that number usually excludes inflation.
Ah, okay. So the real picture is different.
Very different for a company like GE. You have to layer on that 3–4% annual fleet growth we just talked about, plus the fact that these newer engines generally have higher maintenance costs per flight hour,
Yeah.
and then add, say, 2–3% for inflation.
So the actual growth potential for GE's engine MRO business is much higher than that baseline 0.6%.
Significantly higher, yes.
Yeah.
It's like looking at restaurant menu prices staying flat, but ignoring that way more customers are coming in and they're ordering the more expensive steaks, plus ingredient costs are rising.
Good analogy. And engine maintenance is a huge slice of the total MRO pie, right?
It's half. Engine MRO accounts for about 50% of all MRO spending globally, so it's a massive, lucrative market. And strategically, GE Aerospace participates in 4 out of the top 5 aircraft platforms projected to have the highest MRO spending over the next decade.
Including those workhorses, the A320neo and 777 MX.
Exactly. So they are right where the money is being spent, aligned with the most active and growing parts of the global fleet.
We focus heavily on commercial, understandably given its size, but let's touch on the Defensive Propulsion Technologies segment, DPT. How's that side of the house doing?
DPT is a really important part of the business, even if it's smaller than commercial. It provides stability and steady incremental gains. Q2 was solid for them. Revenue grew 7%. Operating profit was up 5% to $360 million. Margins dipped slightly to 14.1%, but still healthy.
And the demand signals, are they seeing strong orders there too?
Very strong. The key metric here is the book-to-bill ratio. It compares orders coming in versus what they're shipping out.
And a ratio above 1 means orders are outpacing deliveries.
Exactly. They had a 1.4x book-to-bill in Q1 and 1.2x in Q2. That means they're building a healthy backlog, signaling strong future revenue and actual defense engine deliveries. They grew 5% in Q1, but then jumped a huge 84% in Q2.
Wow, 84% jump in Q2 deliveries.
Yeah.
What's driving that acceleration?
It indicates they're really ramping up production to meet that strong demand.
What global trends are fueling this defense growth? It seems like spending is up worldwide.
Several big trends are at play. First, you've got modernization efforts everywhere, countries upgrading aging fleets, plus a big push towards localization, countries wanting to build more defense tech domestically.
Okay.
Second, there's significant funding, especially in the U.S., for key propulsion initiatives, next-gen fighters, bombers, helicopters. They want to maintain that technological edge.
And internationally.
International growth is actually outpacing domestic U.S. growth right now.
Right.
That's largely a direct reaction to the evolving and frankly more tense geopolitical landscape.
Yeah.
Countries are reassessing their defense needs.
And GE has a strong foothold in the U.S. military already.
A dominant foothold. GE's DBT powers 2/3 of all U.S. military combat and helicopter fleets. That's huge. And they just locked in a massive $5 billion contract from the U.S. Air Force for their F-110 engines. So, yeah, a very solid foundational business.
Okay, even with all this strong growth and positive momentum, no global business avoids turbulence entirely, right? Especially in aviation. One big headwind has been global trade tensions, tariffs. How is GE Aerospace navigating that mess?
Yeah, that's a really significant challenge, and you're right, it affects the whole industry. GE Aerospace has put a number on it. They estimate that these trade tensions, especially the U.S.-China stuff, could cost them about $500 million in net annual costs.
At $1 billion, that's substantial.
It is, and that's after they try to mitigate it. Just for comparison, a rival like RTX, Pratt & Whitney's parent, pegged their exposure even higher, around $850 million. So it shows this is a major industry-wide burden, not just a GE problem.
So, facing a potential $500 million hit, what's their game plan? They can't just hope tariffs go away, right?
No, they have a pretty sophisticated multi-part plan. First, they're getting smart with government trade programs, things like duty drawback.
What's that?
Basically, if you import parts, pay tariffs on them, but then use those parts in a product you export, you can get a refund on those initial tariffs. They're also using foreign trade zones, more special areas where importing goods aren't hit with duties until they actually enter the U.S. market. It's about optimizing how parts move across borders.
Clever financial engineering, almost.
You could call it that. Second, pure cost control internally. Tightening the belt on SG&A sales, general and admin costs, and just being really careful with non-essential spending to offset those tariff fees.
And third, pricing.
Pricing actions, yes. Targeted price increases on certain products. And they even introduced a temporary tariff surcharge on some things.
On top of their normal price increases.
Exactly. On top of their usual mid to high single-digit annual price hikes in the aftermarket, they've signaled this surcharge would go away if tariffs are removed, framing it as a temporary measure to cover an external cost.
Beyond the direct cost, though, is there a worry that tariffs could actually slow down orders, especially from a huge market like China?
That's a key strategic concern, absolutely. GE has openly said that Chinese airlines' massive customers for both new engines and services might delay buying spare parts or even new engines if China slaps on reciprocal tariffs.
So they've baked that potential slowdown into their forecasts.
They have. They proactively trimmed their 2025 sales forecast specifically for China, just in case. But they stress they see it mostly as a timing issue, not permanently lost business. The planes still need maintenance, fleets still need renewing eventually.
It just might happen later than planned.
Exactly. And more broadly, GE is actively lobbying, along with others in the industry, to get back to what they call zero for zero tariffs in aviation.
Meaning no tariffs on aircraft parts going either way.
Right. That was the standard for decades and really helped global aviation trade flourish. They want to get back to that predictability.
Okay, so tariffs are one major headache. The other one we hear about constantly is supply chains. How have those bottlenecks hit GE Aerospace, and what's their operational strategy, this Flight to Dick thing, to deal with it?
Supply chains have definitely been a constraint, just like for almost everyone else. For GE, it resulted in about a 10–13% drop in LEAP engine deliveries in 2024 and the first part of 2025.
Fewer new engines going out.
Right, which creates this weird paradox. If airlines can't get new planes quickly, they have to keep flying their older planes longer.
Which actually boosts demand for maintenance and parts for those older engines.
Exactly. So the supply chain problem for new engines inadvertently fuels demand in their aftermarket services business. It's a strange dynamic.
Okay, so how are they tackling the root problem? What is Flight Dick?
Flight HDEC is their proprietary lean operating model. Think of it as GE's system, their philosophy for running the entire company. It's all about continuously improving safety, quality, delivery, and cost, and always in that specific order. SQDC.
Safety first. Always.
Always. It's a systematic, data-driven way to find waste, solve problems, and make processes flow better across the whole organization.
Can you give us some real-world examples? How does Flight Dick actually help fix a supply chain problem or speed up repairs?
Sure. Take supplier collaboration. They create a new technology and operations team focused specifically on working closer with suppliers, better demand signals telling suppliers exactly what's needed when, actively helping suppliers break constraints in their own factories.
And that's yielded results.
Measurable results. An 8% sequential improvement in parts coming from suppliers in Q1. And in Q2, suppliers delivered over 95% of the volume GE committed to buying. That's almost double the rate from early last year. So, tangible progress.
What about inside their own shops?
Good example. Their big MRO facility in Selma, Brazil, handles about a quarter of their global engine overhauls. A team there used value stream mapping, a classic lean tool, to analyze every single step of repairing a CFM56 fan module.
And they found ways to speed it up.
They cut the lead time by over 30%, got turnaround times consistently below 80 days. That's huge for airlines waiting for their engines back.
Are they using new tech, too? Like AI?
Definitely. They're rolling out AI-enabled tools for inspecting engine blades. These tools improve accuracy, make inspections more consistent, and cut the actual inspection time by about half. That helps push overall engine turnaround times in their big shops closer to that 90-day goal for engines like the GE Nex and CFM56. It's about using every tool, process, and technology.
It sounds very focused on efficiency. But what about inventory? You mentioned suppliers improving, but if parts aren't flowing smoothly, you can end up with a lot of money tied up in stuff you can't use yet, right?
That's a huge issue, especially when things are volatile. They talked about having roughly $3 billion in trapped inventory during 2023-2024.
Trapped inventory, like parts sitting on shelves waiting for other parts.
Exactly. Imagine you've bought 95% of the parts for 1,000 engines, but you're waiting on that last 5% from bottleneck suppliers. That $3 billion represents materials they've paid for, but can't turn into a finished sellable engine or use in a repair until those missing pieces arrive.
So it just sits there tying up cash.
Huge drag on cash flow and efficiency. So a major goal for them is to improve inventory turns, basically, how fast they use the inventory they have. They want to improve turns by at least one full turn between 2024 and 2028.
How?
Better material flow, better planning, and moving towards more of a pull system with suppliers. Parts get pulled into the factory just when needed, rather than pushed based on a forecast that might be wrong.
Makes sense.
Mm-hmm.
But they still expect things to be tight supply-wise and inflation to stay high.
Yeah, they're realistic. They expect the material delivery environment to remain challenging and inflation to stay elevated for a while. But the plan is for their pricing actions and those flight-dictating productivity gains to offset those pressures.
Okay, beyond just getting parts and engines delivered, the durability and reliability of those engines is absolutely paramount. Job number one, really. How is GE ensuring their engines stay reliable, especially the newer ones?
You're absolutely right. Durability and reliability are non-negotiable for airlines. It's all about time on wing, keeping those engines generating revenue on the aircraft, not sitting in a shop. GE is laser focused on this through continuous improvement.
Like with the LB engine, I know there were some early adjustments needed.
Right. For the EPA-1A, which powers a lot of A320neos, they rolled out a key durability kit in late 2024. The centerpiece was an upgraded HPT blade high-pressure turbine blade.
The hotbed at the core?
Exactly, the really critical part that takes the most stress. Think of it like giving the engine a stronger heart. This kit is now standard on all new EPA-1A deliveries and gets retrofitted during shop visits.
And the impact.
It's improved time on wing by over twofold, bringing LPA durability much closer to the benchmark set by the older, incredibly reliable CFM56 engines. That's a massive win for airline operating economics.
Huge. Fewer costly shop visits, less disruption. Are more upgrades planned?
Yes, continuous improvement is the mantra. A similar durability kit for the LEP-1B, the one on the 737MX, is expected in the first half of 2026. And even further, HPQ blade design improvements are certified and going into production in the second half of 2025.
And customers are noticing this focus on durability.
The market share tells the story. They've won over 70% of the engine orders on the A320neo family since 2023. That suggests airlines value these durability enhancements. And it's not just LAP. Remember the GE engine on the 787?
Right, the wide-body engine.
A durability upgrade back in 2021 significantly increased the time until its first major shop visit from about 2 years up to around 5 years, or 4,000 flight cycles. Again, huge savings for operators.
Okay, what about the newest engine, the giant GE9X for the upcoming Boeing 777X? How are they making sure that one is durable right out of the gate, learning from past experiences?
The GE9X is really the culmination of decades of learning. They're calling it the most tested engine in GE history. We're talking over 30,000 cycles of testing.
30,000. What does that involve?
It includes 8,000 really punishing endurance cycles, simulating years of operation, and get this, 1,600 dust ingestion tests. Basically deliberately feeding it sand and dust to mimic harsh environments like the Middle East.
Wow, trying to break it before it even flies commercially.
Pretty much. And all that testing, informed by lessons from JNX and LEAP, led to design improvements before launch. Things like the second generation of those critical HPT blades and using more advanced materials like ceramic matrix composites or CMCs in the nozzles.
CMCs, those are the super light, super heat-resistant materials.
Exactly. They allow the engine to run hotter, which means more efficiency, but they're also incredibly durable. So the goal is to have the GE9X be as mature as possible when it enters service, hopefully in 2026.
Minimize those early teething problems.
Minimize them significantly. Now, they do expect some initial financial losses in the first year or so after entry into service. That's typical for huge new programs like this. But they see clear profitability for the GE9X coming in the 2030s as the fleet grows and the services kick in.
Speaking of the future, let's really get into the next generation stuff. GE, through CFM International, is working on this program called CFM Rise. Sounds Revolutionary, open fan architecture. What is that?
Yeah, RISE is where things get really exciting, really forward-looking. It stands for Revolutionary Innovation for Sustainable Engines. And that name isn't hype. It really is their most ambitious, most transformative tech effort.
So not just tweaking current designs.
Not at all. This is a technology demonstrator program aimed at a step change, a leap forward. And the core idea is this open fan architecture. Picture a modern turbofan, but imagine removing the big nacelle, the casing, around those front fan blades.
So the fan blades are just open, exposed.
Essentially, yes. The idea is to unlock massive gains in propulsive efficiency, how effectively the engine pushes the plane forward by making the fan system much larger and more efficient, rather than just trying to squeeze more performance out of the hot core of the engine.
Why is that better? Getting efficiency from the fan instead of the core.
Because pushing the core hotter and hotter is a major driver of wear and tear, leading to more frequent maintenance and removals. The open fan concept shifts the focus to the fan, potentially allowing the core to run less stressed, which could improve durability. It's a fundamentally different approach.
An open fan. That sounds radically different. Huge engineering challenges, I imagine, but also huge opportunities. What are the main goals for RISE, especially around things like safety and efficiency?
The challenges are definitely immense aerodynamics, noise, integration with the aircraft. But the potential payoff is equally huge. RISE is built on three key pillars. First, safety.
Which has to be number one with an open fan.
Absolutely. They're leveraging decades of experience with composite fan blades. Crucially, the open fan blades will actually spin much slower than in a traditional engine, maybe 1/6 the speed. That slower speed, combined with advanced materials and design, is key to ensuring safety, even without that traditional containment nacelle.
Interesting. What about noise? Would it be louder?
Counterintuitively, maybe not. Because it spins slower and moves a larger volume of air more gently, it's actually expected to be quieter than today's LE engines. That could be a game changer for airports and communities nearby.
Quieter and more durable.
That's the goal for the second pillar, durability. Because the core isn't being pushed quite as hard, the efficiency comes from the fan they're aiming for durability that's as good as, or potentially even better than, today's best engines.
And the third pillar, efficiency. That's the big driver, right?
That's the headline grabber. RISE is targeting a step change, over 20% improvement in fuel efficiency compared to current engines like LEAP.
20%. That's monumental for airlines facing fuel costs and sustainability pressures.
It's exactly the kind of leap forward airlines say they need to justify investing in a whole new generation of aircraft. And it's obviously critical for hitting the industry's ambitious climate goals.
So a 20% fuel burn reduction, potentially quieter, potentially more durable. How far along is this visionary project? When might we actually see an open fan engine flying?
Development is moving along seriously. They've already run over 350 different tests for the program. There's a big early focus on proving out the durability. They're advancing new cooling tech for the HPT blades, testing full-size open fan blades, and they've done over 3,000 endurance cycles on components.
So real hardware being tested.
Absolutely. And they're working very closely with Airbus on how you'd actually integrate an engine like this onto an airframe. It's not trivial. The engine interacts with the wing very differently.
Right, the aerodynamics must be complex.
Sorry, but ground tests and actual flight tests on a testbed aircraft are anticipated later this decade. So it's not science fiction, it's active development aiming to invent the future of flight, with sustainability right at the core.
Okay, shifting from commercial back to defense. GE is pushing boundaries there too, right?
Yeah.
We touched on the DPT segment's performance, but what about the next generation of military engines? Adaptive cycle engines.
Yeah, the innovation is just as intense on the defense side. The XA100 adaptive cycle engine program has been a major focus.
Adaptive cycle. What does that mean again?
It means the engine can actually change how it operates in flight. It can vary its bypass ratio, how much air goes around the core versus through it, to optimize for either maximum thrust when needed, like in combat, or maximum fuel efficiency for cruising or loitering, kind of like having two different engine modes in one.
Best of both worlds.
That's the idea. And the XA100 test showed really significant gains. up to 20% more thrust and an incredible 25% better fuel consumption compared to current fighter engines.
Huge advantages for range and performance.
Absolutely game-changing. That technology is now evolving into the XA-102 engine, which is aligned with the U.S. Air Force's big program for future fighters called NGAP, Next Generation Adaptive Propulsion.
And there's funding support for this kind of tech.
Significant support. Congress recently put $750 million towards the FAXX program, which is envisioned as a sixth-generation fighter. Exactly the kind of platform that would need an adaptive engine like the XA-102.
And GE's defense work isn't just U.S. focused, right? They're involved internationally, too.
Definitely global. Through their Italian subsidiary, Avio Aero, GE is actually an equal propulsion partner with the UK and Japan on GCCAP-P, the Global Combat Air Program.
That's the project for a new European-Japanese fighter jet.
Exactly. Aiming for service around 2035. So GE's right at the heart of that major international collaboration. They're also working on smaller engines, partnering with Kratos on the GE 1500 engine for affordable drones, unmanned systems.
There's a rapidly growing area.
Huge growth. And then there's the really cutting-edge stuff. Hypersonics.
Flying at Mach 5+.
Right. GE is making major investments in building out the test infrastructure needed to accelerate development of hypersonic propulsion for both potential civil and military uses. It's another area where they're positioning themselves for the long term.
Okay, with all this incredibly advanced technology, commercial and military, safety has to be the absolute bedrock. How does GE Aerospace embed safety into everything they do? Is it just culture, or are there specific systems?
It's absolutely foundational. It's deeply embedded in their culture, built up over decades. And it's not just talk. They consistently get top marks, rated green, on the FAA's Safety Oversight Scorecard, the ODA scorecard.
What really stands out is how proactive they seem to be.
That's the key. They were actually the first manufacturer to have their internal safety management system, their SMS, formally accepted by the FAA. That was way back in 2013.
A decade before the FAA even proposed making SMS mandatory for manufacturers.
Exactly. A full decade ahead of the curve. It shows a deep, proactive commitment, not just waiting for regulations. A core part of that SMS is having a strong, open reporting culture where employees feel safe raising potential issues without fear of blame.
Find problems early, fix them fast.
Adds to the principle.
And does their flight deck system play a role in safety too?
Absolutely. Remember, SQDC, safety, quality, delivery, cost. Safety is always first. FlyHDDIC helps standardize processes across the board, which supports rigorous safety investigations and ensures corrective actions are implemented effectively. It also drives things like extending enhanced safety inspections down to the individual module level on engines.
Getting more granular with checks.
Right, and they're using those AI-enabled inspection tools we talked about not just for efficiency, but to improve accuracy and consistency in finding potential issues. Even using AI to try and predict potential safety threats by analyzing vast amounts of operational data.
Predictive safety.
It's about leveraging every tool. Their message is crystal clear. Everyone owns safety, and they never, ever compete on safety. It's just fundamental.
Okay, let's bring this all together now and look at the financial path forward. All this innovation, operational improvement, market dominance, how does it translate into future results and value for shareholders? They just updated their 2025 guidance and gave a longer view out to 2028. Sounds like they're aiming even higher.
They definitely raised the bar. The updated 2025 guidance from July reflects increased confidence. Adjusted revenue growth, they bumped that up to mid-teens year over year from low double digits previously.
So faster top-line growth expected.
Yep. Adjusted operating profit, now projected between $8.2 and $8.5 billion. That's a $350 million increase at the midpoint compared to what they guided just back in April.
Significant jump.
Right.
And earnings per share.
Adjusted EPS now forecast at $5.60 to $5.80. At the midpoint, that's over 20% growth compared to the previous year. And critically, free cash flow is also raised, now expected between $6.5 and $6.9 billion.
What's driving this increased optimism for 2025? Better execution, market conditions.
A mix of factors. One key thing. Less risk now assumed for spare parts and engine deliveries, partly because those feared reciprocal tariffs from China haven't materialized, at least not yet. Also, material availability from suppliers is steadily improving, and the overall outlook for services just looks stronger than they anticipated earlier in the year. It reflects good execution meeting favorable or at least improving conditions.
Okay, that's 2025.
Yep.
But these are long-cycle businesses. What about the longer-term outlook they provided? Out to 2028. How ambitious are those goals?
The 2028 outlook is where you really see the scale of their ambition and confidence. They expect to sustain double-digit compounded annual growth, CAGR, in adjusted revenue right through to 2028.
Consistent, strong growth.
Exactly. Adjusted EPS is projected to reach around $8.40 by 2028. That's a mid-teens CAGR. Adjusted operating profit. They raised that target significantly, now aiming for approximately $11.5 billion.
How much higher is that than their previous 2028 outlook?
It's a $1.5 billion increase. That would mean margins expanding to over 21% and represent over $3 billion in profit growth just from 2025 for 2028.
Where is that $3 billion plus in profit growth primarily coming from?
Overwhelmingly from commercial services. They project nearly $8 billion in additional commercial services revenue between 2025 and 2028. That's the powerhouse.
And free cash flow by 2028.
Also increased significantly, now targeting approximately $8.5 billion, which is another $1.5 billion hike from the prior outlook. And they expect cash conversion, how much profit turns into actual cash, to be right around 100%. Very strong.
Okay, hitting those big numbers requires a lot of things to go right. What are the specific levers they expect to pull to drive that profit growth and margin expansion?
It's a combination. First and foremost, that huge wave of commercial services growth we just mentioned. Second, steady growth from the defense DPT segment. Third, continued strategic pricing actions to more than offset inflation. Fourth, getting about 2 percentage points of gross productivity improvement each year from Flight Deck doing more with less. And fifth, continuing to invest heavily in R&D to keep that technology pipeline full. It's hitting on all cylinders.
Let's double-click on that commercial services growth since it's so critical. Can you break down the outlook within that segment, narrow body versus wide body?
Sure. For narrow bodies, think ALA and the older CFM56, they expect low double-digit CAGR in revenue. That's driven by the massive growth of the ELA fleet as more planes enter service and start needing maintenance, plus continued stability from the huge existing CFM56 fleet.
And they expect LE to become as profitable as CFM56 eventually.
That's a key milestone they're targeting. LEP engine profit reaching parity with CFM56 profit by the end of this decade. That shows the long-term economics of the new engine program working out.
What about wide-body services, GX, GE90?
There they expect high single-digit KGR revenue growth. That's mainly driven by the GE Next engine on the 787 and upcoming 777X, plus continued stable revenue from the large installed base of older CF6 and GE90 engines.
You mentioned the older foundational fleets, CFM56 and GE90 being stable. Are they proving more resilient than maybe people thought, not retiring as fast?
That's exactly what's happening, and it's great news for GE Services business. These engines are just workhorses. CFM56 shop visits, for instance, are now expected to peak later than previously thought, probably around 2027. They've added about 600 additional shop visits to their forecast through 2028 compared to what they expected before.
Wow. And the revenue stays stable even after the peak.
Expected to, yes. Because even if the number of visits plateaus, the price per visit tends to go up, and the work scope, how much work is done during each visit, often increases on older engines. So stable revenue despite fewer absolute visits eventually. Retirements will tick up later in the decade, maybe 3–4%, but still very resilient.
Same story for the big GE90 on the 777s.
Similar story. Internal G90 shop visits are projected to keep growing through 2028, about 100 more visits added to the forecast. And the average work scope on those visits is expected to increase by 30% between 2023 and 2025. So more work being done per engine.
Okay, turning to the newer LEP engines, their numbers are obviously growing fast. How is the aftermarket for LEP shaping up? Is it becoming profitable quickly?
The LEAP aftermarket is the massive growth engine for the future. The installed base is set to roughly triple by the end of the decade. Internal shop visits will grow at a similar blistering pace.
What about work done by third-party shops? Does GE still benefit?
Yes, significantly. External shop visits are projected to grow from about 10% of the total today to around 30% by the end of the decade. When an external shop does the work, GE sells them the high-margin spare parts needed for the repair, so it drives lucrative parts sales.
Got it. And are they getting better pricing on service contracts for LEP compared to the early days?
Yes, pricing on new LEAP service agreements is improving, reflecting the engine's maturity and value. But maybe the most important strategic piece here is investing in repair technology.
Repairing parts instead of replacing them.
Exactly. They aim to more than double the number of LEAP-specific repairs they can do by 2028. Why? Because repairing a complex part might cost only 50% as much as buying a brand new one.
Which saves the airline money.
And improves GE's margins and speeds up turnaround times because you're not waiting for a new part. It's a win-win-win, big focus area.
All these growth plans sound great, but they depend on generating cash. How confident are they about turning these projected profits into actual free cash flow? That 100% conversion target sounds ambitious.
They seem highly confident. That projected 100% conversion through 2028 is driven by a few key things. First, just increasing output, shipping more engines, doing more shop visits. Second, finally getting a handle on that trapped inventory by improving inventory turns by about 1 full turn. That frees up billions in working capital.
Less cash tied up on shelves.
Right. And third, just consistent cash collections from that growing installed base and higher flight activity. As utilization goes up, service billings rise. They project LAP billings to grow 2.5 times and GX billings 1.5 times between 2024 and 2028. That consistent inflow really drives cash conversion.
So if they generate all this cash, what's the plan for using it? What's their capital allocation strategy? Balancing reinvestment versus returning cash to shareholders.
They have a very clear 3-pillar framework. Pillar 1, invest in growth and innovation. This is non-negotiable.
R&D, new facilities.
Exactly. Around $3 billion for R&D in 2025, keeping that at 6-8% of revenue annually, plus over $1 billion for MRO facility upgrades over 5 years and another $1 billion for supply chain strengthening. Got to keep investing to stay ahead.
Okay, pillar 2.
Return cash to shareholders. They state a strong bias towards this. The plan is to return over 100% of their free cash flow through 2026.
More than 100%.
How? Through a combination of dividends and significant share buybacks, potentially dipping slightly into existing cash reserves initially. They just increased their planned returns for 2024-2026 to $24 billion total.
Up from what before?
Up from $19 billion. So a 20% increase in planned returns. That $24 billion breaks down into roughly $19 billion in buybacks and $5 billion dividends over those 3 years.
In a longer term, after 2026.
The commitment is to return at least 70% of free cash flow annually through dividends and buybacks, so a sustained significant return to shareholders.
And the third pillar, mergers and acquisitions, M&A.
Focused M&A. They're open to opportunistic bolt-on deals, smaller acquisitions that complement their existing business. But they emphasize a very high bar. Any deal has to make clear strategic, operational, and financial sense. No big, distracting empire building. Focus remains key. Hashtag tag outro.
Well, as we wrap up this deep dive, it really feels like GE Aerospace is a fascinating case study. A company that successfully spun off, found its focus, and built this incredibly resilient, service-driven powerhouse.
Absolutely. They're innovating right at the cutting-edge commercial with things like open fan, defense with adaptive engines, and underpinning it all is this relentless operational discipline through flight deck and smart financial management.
It really seems like a recipe for sustained growth and, as they clearly intend, strong shareholder value for years, maybe decades to come.
And understanding a company like this, it gives you such valuable insight, doesn't it? Into high-tech manufacturing, into these incredibly complex global supply chains, and just the fundamental tech that keeps our modern world connected and moving.
That invisible infrastructure we talked about at the start, their commitment is so long-term. Decades-long engine programs, deep customer ties, huge R&D bets. It makes you wonder.
What comes next?
Yeah. Considering this relentless push for durability, for that huge leap in fuel efficiency with OpenFan, for using AI and predictive maintenance, what future shifts in aerospace might we not even be anticipating today?
Shifts driven by these long-term investments.
Exactly. How could these leaps reshape not just flying, but maybe related areas? Quieter engines, changing urban planning near airports, demand for new materials driving breakthroughs in material science. What stands out to you about how this could transform things in unexpected ways down the road?
That's a fantastic question to ponder. The ripple effects of these kinds of foundational changes, they often go much further and wider than anyone predicts at the start. It impacts entire ecosystems.
Something for all of us, our learners, to think about. Thank you for diving deep with us into the world of GE Aerospace. Keep learning, keep questioning.
And until next time, stay well informed.